inclusive, and accountable. Because people want to know and deserve to know how their money is being spent. And just as it's important for the city to plan how to use our money wisely and make good investments, it's just as important for every Angelino to do the same. Because the financial health of our city, of our communities, depends on the financial health of every Angelino. Financial literacy and financial planning for individuals and families is crucial to success, and so is making positive financial choices for today and for the future, so that you can get bills paid, make the rent, save up for a car or a home, further your education and that of your loved ones, retire, plan for trips and vacations, and so much more. I want to thank so much our outstanding LA City Library and its leadership, including Chief Librarian John Szabo. Thank you to all the staff and the volunteers, notably our certified financial planners, and the library's Department of Lifelong Learning and its partners. And thank you for ensuring everyone has the tools and resources necessary to plan, save, invest, and manage their finances for the future, for their family's future, and for our city's future. To help with this, I would encourage you to check out my How to Build a Financial First Aid Kit tool, which gives you information you'll need to be prepared in case of an emergency. And you can find the kit at lacontroller.org/financial first aid kit. I wish you a positive and fruitful day of financial planning, and thank you all for participating.
Thank you, Mr. Galperin. Hi, everyone. I'm Caroline Zakarian, and I work for the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to Financial Planning Month. Today's presentation is called the Investments Workshop, Be a Smart Investor, and it's part of a month of programs devoted to financial planning. This program is brought to the Financial Planning Association of Los Angeles and the Los Angeles Public Library. Today, Jamie Ruck from the FPA will talk to you about investing and investment concepts, explain how investing fits into an overall financial plan, and talk about, sorry about that. Okay. General investment. Okay. She also just talks about how discipline plays a key role in becoming a successful investor. There will be a brief Q&A after the presentation, and so students will catch us throughout the program. Sorry about that. Thank you, and take it away, Jamie, for all your knowledge. Thank you.
Thank you, Caroline. It is a pleasure to be with everyone today. Thank you for joining us this afternoon to talk a bit more about how to be a smart investor, how do we get started with investing. And we are going to get going on our presentation here. All right, so as we get this loaded in, one thing to note as we get started, we are going to be talking, I'm from the Financial Planning Association of Los Angeles. As part of Financial Planning Month, October is Financial Planning Month across the country. We do have a number of pro bono financial planning appointments available that we are conducting. We did one on the 1st as well as the 15th of this month on the Saturday. We are at a waiting list right now for those appointments, but we'd love to see you if you're able to attend and sign up for one of those appointments, and we'll do our best to accommodate you. So for today, what we're going to cover, we are going to explore investing and investing concepts. We'll explain how that investing fits into your overall financial plan. We'll introduce some general investment strategies and discuss ways to actually put these strategies into action. Because if we just leave it where it is now, we don't apply what we've learned, then it doesn't actually help us move forward. What we're not going to do, we're not going to make anyone a stock picker, provide insider information, or recommend a specific course of action for what you should do. Every one of the bits of information you'll hear today, we want you to take it in and listen and feel out whether it's talking with a financial professional or with yourself, if it feels like the right move for you, if it feels appropriate for what you're looking to accomplish. So to start with that, we'll talk about a number of key concepts that revolve around being a smart investor. It's not just picking the actual stocks and bonds or in your portfolio. A lot of it goes into a couple of these key components in financial planning. That's namely saving, investing, looking at the risk and return dynamics, talking about asset allocation, which is basically the percentages you have to the various categories that you're investing in, diversification, or spreading out your investments so you're not just invested in Apple or Tesla, for example, so you don't experience all of the ups and downs, and also a bit about asset location that we'll get to at the very end. As we go through the slides today, if you do have questions, we will have time, as Caroline mentioned, for Q&A at the end, so please do feel free to add those in, and we'll do our best to address those at the end of the presentation today. We should be going about 45 minutes, so we should leave at least 10 minutes for questions. So just to get us started, we'd never, as a financial planner, we would never want to start off a conversation about investing without first talking about saving and the importance of saving. So what really does that? What does that mean? Putting money in a traditional savings account, right, or a money market account, the savings we have just tied to our checking, they can earn regular interest. This has been very low in the past, a low interest rate, but with increasing rates of inflation right now, we are starting to see interest rates creep up for what your bank is paying you if you leave your money in that account. Also, saving lets you have the money right when you need it. One thing I think we've all experienced with the upheaval from 2020 and the pandemic was how important it was to really have that backup emergency, rainy day fund, emergency savings, just for the just in cases. We want to have usually at least 3 to 6 months worth of our fixed costs, so rents or mortgage or car payment, insurance, enough money for groceries, those crucial things. We want to make sure we have at least a few months of that set aside so that we can weather the storm if something were to occur that we don't anticipate. Also, when you do actually save in a typical account like this, a lot of those accounts are backed by the federal government, and the assets are safe. If something were to happen with the actual bank or whatever, the government will make sure you are reimbursed for those monies, so they are protected. So all of these different components actually come up with what we call saving. So when we talk about investing, though, that is more when we are looking to set aside a bit of our money, invest it in some specific type of asset with the hope that it will either increase in value, provide us additional income on a regular or annual basis, or both. The key part about investing, though, and that we're going to cover a lot later on in our session today, is to expect that fluctuating rate of return. If anyone has looked at any of the headlines this year, we've seen how much the stock market has been all over the place, and it's had actually a bit of a difficult year this year. So it's important to note when you are investing, you want to make sure it's not the money that you need for your daily living expenses. It's money that you are going to be investing for the future. Also, the assets are at a specific market price if you need immediate cash. So another point, if you do need money right away, you're going to be subject to whatever the value of it is on that given day. And then also recognize that there is a potential for losing, like we're saying, as well as making money, because these assets are not insured. They're not backed by the government. So there is a potential for loss as well as those gains. So some of those reasons to save and invest, and kind of what's the difference? Like, why would I save versus invest? It feels like the same thing. It's money I can't necessarily use right away from my paycheck, right? But so savings from our perspective really fall into the category of making sure you're covered for those emergencies, like we mentioned, making sure you're going to be okay. You have enough. If your child gets hurt, you get hurt, something occurs, we have enough to cover those initial medical bills. Also, things like vacations, things you're looking forward to doing. Maybe also saving short-term goals like your down payment for a car or a lease, saving up for a down payment for a house, things like that that are shorter term in nature often fall into the category of something we want to be saving for rather than investing that money. And we'll explore that a little bit more as we go forward today. On the investing side of things, we're thinking things a little bit longer term, farther out. Things like college, right? Retirement, buying that dream home, or buying that other goal that you've had on your mind for years, things you'd like to see accomplished in the future. We want to be able to take advantage of the markets and let that money grow over time. So when we want it and we want to use it in the future, it's ready for us. So along those same lines, and I apologize, it's a little light here. What is financial planning? So when I say that I am a certified financial planner, that means I have a fiduciary obligation to clients, and we predominantly provide financial planning. So there are a number of different components of financial planning rather than just the investments only. So it is a process for us to review any individuals, all of the various financial components that make up their financial life, and provide and take into account your goals and objectives, what you're looking to accomplish, and then actually develop a plan in order to help you reach those goals. So within that realm of financial planning, there are a number of different kind of buckets. Insurance, we want to take a look at what risks have we not accounted for? Do you have enough coverage on your auto insurance in case something were to happen? Employee benefits, looking at retirement plans. Certainly investments are a big component we're focusing on today. We also review tax planning, helping make sure everything is covered from a tax perspective, and we're optimizing that for a tax perspective. Retirement planning as well, checking if we are on track for retirement, what we can do to catch up, or if we're in a good place, providing that sense of security, as well as estate planning. And that's really going into making sure you have a will or a trust and a power of attorney documents. If you would like to learn more about estate planning, next Friday we are having a workshop on the introduction to estate planning, the key components of what that means when you talk about estate planning, and what things you should really consider having if you don't already, just to protect yourself and your family. So to get back to investing though for today, before you do invest, kind of like we were mentioning, we want to make sure that you really understand your current money, your money in versus money out, that your cash flow. If everything is going to set expenses, whether it's covering student loan payments and credit card debt and all these other things, as well as what you need to live, you want to take a close look at where your money needs to go first before putting a number of dollars into certain investments, because again, we want to think longer term time horizon for these. Build up that emergency cash funds, that emergency reserves, that you know you're going to be okay. If no one takes anything away from our conversation today, please make sure that if you don't have that savings to cover a few months of expenses, that you start to at least put a little bit in each paycheck to make sure you have a little bit of a cushion in case things get rocky. Also, if you do have a lot of credit card debt, with those high interest rates, we always recommend trying to whittle that down before really turning your full focus to investing. You can do a combination of both, but it's important because of how high those interest rates are, anywhere from 15 to 20% extra you're paying on that money, to take care of that first before you start investing. And also looking at making sure you're protected in the right way with your insurance products, that you're covered in those areas. And also naturally, kind of falling in line with what we were just talking about on the different components of financial planning, writing a will. Making sure you do have something written on paper that's signed and dated, ideally notarized. So if something were to happen to you, none of us ever would want that or expect it, but if something were to occur, what happens to any of the investment accounts you own, or your car? Who's going to, on the scarier side of things, who is actually going to be the guardian of your children? The court system actually decides that. So these really important components to make sure we have our financial house in order before we start focusing that time on investing. So when you are going to get started with investing, a couple key areas to consider that might already be available to you, or you might already have. The first one always that we come across is if you have a retirement plan, 401k or 403b plan at work. If you're eligible to participate in a retirement plan, you have a built-in, usually HR, that will help you set those accounts up. You can have that money come out of your paycheck directly. It usually has some extra tax preferences because money is either not taxed on the way in. More to that later. That's focused more around retirement planning. We can focus on that in another workshop. So that is always the first one we will ask you. Do you have access to a retirement plan at work, or are you eligible to participate in one? Other options that you might have heard of, an IRA, you hear all the commercials about IRAs, investing in IRAs. That stands for an individual retirement account. It is also has additional protections. There's some tax benefits too, some tax deferred status, just like a 401k or a 403b plan. And the money is also protected. So kind of like we were talking about with that FDIC insurance when we look at savings accounts, individual retirement accounts, IRAs, as well as your 401ks actually have some additional protection or kind of insurance from the federal government. These accounts are meant for the long term when we are in our later years and we're no longer working. So there are additional protections for those, including even creditor protection. So money in your IRA cannot technically be tapped into by a creditor for those purposes. And then also contributions to a college savings account. That's another way that people can often get started with investing, as well as what we call a taxable account, meaning money that you've already received, you paid your taxes on it, it came through your paycheck. You have some extra money, you've looked at your income, you looked at your expenses coming in and out, and you have a little bit left over. And you've already invested in your 401k or some of these other accounts. You actually have some left over you can put into a taxable account to invest on your behalf for the future. Whenever we approach talking about it, embarking on a new area, or we always want to talk about a plan. We're financial planners. You'll always hear us talk about creating a plan. Just like when you have a plan for any kind of aspect in your life, when you're thinking longer term, there are multiple steps involved. We want you to also think about creating an investment plan, even if it's just something you think about for yourself or write down on a piece of paper. So really identify what are the goals I'm trying to accomplish, and how long do I have for that money to be invested? That is actually a key component for us to add and to consider when thinking about investing. As much as we want the money to be invested as long as possible because it benefits from being in the account as long as possible. Really, we want to tie this more back into what really matters to you. What are you looking for in the coming years, whether it's 3 to 5 years from now? What about 5 to 10 years? What about 20 years? What do you want your life to look like then? What are the goals you have for each one of those kind of time frames? And that actually is a huge component, kind of almost a key component in deciding what really can be an appropriate investment for you. Balancing risk and return. For as much as we wish everything would go up just on a straight, steady line throughout the course of investing, that's actually not how it works. We are adding on we're putting our money into other companies basically with the hope and expectation, but hope that our money is going to, like we said, it's going to grow, it's going to produce some income, or both. So we want you to think about that and also create an investment strategy. Even if it's you know what, I'm not really sure what all this is, but I know I want to have this money stay in here for a long time. I'm just going to leave it. My goal is for it to grow as much as possible for the future, for 20 years from now, for me to be able to retire earlier than I currently think I can. Also, when you're going through that investment plan, what are the individual investments you want to add to that? What are you thinking to put in there? You want to make sure you have a list so you know what types of investments you're getting yourself into. And then a key one also is to periodically keep an eye on your portfolio and update it as needed. The same thing would be said too with your 401k or your 403b accounts from work. While we don't recommend checking the investments every single day, today is another terrible day in the market. So this is a case in point of why we don't want to be constantly tuned into those headlines. Some markets are going to move up, they're going to move down. We want to stick to our strategy, but it is important at least annually, if not quarterly, to check in on those investments. How are they doing? Do you need to make some shifts? And setting a reminder for yourself on your calendar can be really helpful as well. So when you talk about that component of risk and return, we mentioned, kind of already highlighted a bit of this, But risk, and I'll read from the slides here, is the possibility you could lose some of the money you invest. That is a natural part of what we're seeing today. An example would be what we've seen in digital currencies and Bitcoin and crypto this year. They've gone down. There's been quite a bit of risk, and they've actually lost quite a bit of money this year. The more risk you take, meaning the more risky investments you make, the greater the potential is for a larger return or a larger loss. So you are getting paid for every dollar, basically. And how we look at this, you're getting paid for, or you should be, how much risk you're taking on, for how much return you're getting for each unit of risk you're taking on. The riskier the investment, the higher you would expect to get a higher return because you're taking on that more risk. And again, the return component is what you get back from that. So if you are in really safer, quote unquote, safer investments that have less risk, you can reduce how much you'll actually be able to grow that account or that investment, but how much you actually could lose is also reduced. That's why we predominantly in the past have seen a lot of people who are older investing more in bonds or fixed income because they have a different risk return profile. We don't expect to get as much as a result of investing in it, but we also don't expect it to move quite as often when the market is zigging and zagging like we're experiencing in 2022. So to go along the lines of understanding your personal risk tolerance, these are the questions I'd like you to ask yourself, even if you're listening today, and just think these through or jot them down on a piece of paper. So if you're looking to get started with investing or continue on with investing, are you willing to lose a little bit of principal in pursuit of those higher returns? Yes or no? Are you willing to stomach potentially losing some of that hard-earned money because you think that in the future that could be worth more? If a key component to think about. Do concerns about your current investments keep you awake at night? If we are in investments that are so stressful that we're losing sleep, frequently we're not in the appropriate investments for us. We want these to be here in the background, your investments for you in the long run, but they should not be keeping you up at night. So consider, if you feel that way, there's a chance you're in investments that are a little too risky for your comfort level. And do you make changes to your investment account every time the market drops? I have a slide later on that will kind of go over this in a little bit more detail, but it's a really important thing to take stock of. If you see the markets drop and you get really concerned and you move your money out, that is something you certainly want to think about and address. And if you're working with an advisor or financial planner, make sure they understand that. They should ask you that anyways. But really think about if that happens, you might be in too risky of investments. And then how often do you monitor your accounts? Do you keep an eye on them frequently? Do you check them daily? Do you check them just on occasion? Again, watching them daily, not really something we like to see happen just because the markets are going to move every day. They're going to be moving up or down. But again, we do want to make sure that you check in on them every once in a while. And naturally, it's important to be realistic with our investments. We do recognize that markets can gain and lose value in market cycles. We are technically on the late stages, likely downward part of end of a very long economic cycle we've had. We are seeing some losses across the board right now as a result of some of these market dynamics. And again, remember that if you use only an insured account, like your savings account through your bank, your return is going to be very limited. Or if you're in very, very safe investments, you can expect that account to increase in value pretty significantly. And then also evaluate what can you reasonably expect? What is appropriate? What do you think is going to be coming? What do you think you're going to receive as a result of these investments? It is important to be realistic because it will provide a little bit of data points in just a moment of what those returns can look like. But there's a lot more to that. We can't expect to overnight have our accounts go up 50 to 100%, and that's just to be how the things are going to be in the future. That's just kind of not as realistic. But to put some actual data to what we're talking about, this is actually a look at the growth of $1 over the course of almost the last 95 years. This is from 1926 and through 2022. And you'll see that the stock market on average, this is over the course of that entire time frame, and that's including World War II, all the recessions, inflation, the Great Depression, all of these different things. Still, overall, the average return, annual compound return for stocks is 5.5%. When we look at some of the different bond categories, it's a little over 1 for certain types. And then actually the treasury bills, or those really safe kind of paper from the government, it's actually a little bit negative when we look at inflation and how inflation impacts the value of our dollars. I think we've all probably seen this year, between gas prices, food prices, housing, you name it, inflation does erode away our purchasing power. Doesn't mean we're actually losing money, but if I have $100 last year and our inflation is at 8% this year, technically my buying power has been reduced by 8%. So that my $100 last year is technically only worth more like 92 today. So I'm just able to buy less goods with my money, even though it still says 100, in the account or on my paycheck. But what we're able to buy it from that is reduced. I'm going to quickly touch on this, a bit of volatility over these different time frames. When we look at some of these time periods, this 1930 to 1939, talking about the kind of the Great Depression and some of the difficulties that the country experienced, these are the average returns for each one of those years in that time frame, as well as the standard deviation. And standard deviation, in a very simplified way of saying it, is really just that volatility, how much it's moving, how much the things are actually impacted, how much they're moving over the course of the year or the time frame, how much the returns are all over the place. But for most of these, and rather than looking at all the specific numbers, a key point to mention is pretty much in all of these categories, minus the 1930s and the 2000s, every 10-year time period has been pretty to very, very positive annually, averaged over the course of those timeframes. But now I apologize, skipping ahead. Talking about time and diversification. So this is the kind of a perfect sign if to tune into for a moment for anyone that's been seeing, if you looked into your 401k account or your investment account this year, you've seen how much it's moved in value and generally in the negative direction. This is really important slide to look at or take a screenshot of. And I can share where you can actually find copies of this in detail if you'd like to see them. So we want to look at it, the combination of stocks, bonds, and like a 50-50 portfolio over time. So 50-50 meaning 50% stocks, 50% bonds. On the left-hand side, in any given 1 year period, we see the market in this historically, it's gone from either market's been up 47% on average, or it's been down dropped 39% in 1 year. And bonds, similar, 43% up to 8% down, and a blend of the two between negative 15% up to 33% of increase in a 1 year period. But as we move farther out, as we look at a 5-year time period, a 10-year, and a 20-year, you see that a lot of these numbers start to come together because what we experience, that volatility, that huge swings we see in the market like we're experiencing this year, that's not how it's always going to be, and it's not always going to be, we're not always going to experience that much movement. Over time, those do average out. And what's the important thing to notice on this, regardless of what's happening this year, what happened in 2020 with the markets, the bounce back, the drops, the economy, over time, as we move further out, and when you're looking at the 10-year plus period, there has never been a time in that 10-year period in the US markets when if you were invested in a combination of stocks and bonds, in this case, a 50-50 portfolio, when you were actually negative in total over those 10 years. So even though we see a lot of things going on in the headlines today and in the markets today, it is important to note this too shall pass and it will average out. And we have yet to experience a longer time frame, even at a 5-year mark, that's actually negative when you have a combination of stocks and bonds. And same thing, further out you go, the higher those numbers are for the actual average return over the time frame, 11.5%, bonds 5.8. So if you were to do a 50-50, that's actually a 9% average. If that was $100,000 over the course of 20 years, that actually would grow to 562,000 in this example, from 100,000 to 562 in 20 years, based on the historic data from the last 71 years. And that's why we do want to be invested when we can, because of this growth potential in the long run. So when we talk about asset allocation, we kind of mentioned that was talking about that 50-50 half stock, half bond portfolio. It really is, it's your strategy. You're talking about your investment plan. It's how are you breaking down how much stocks versus how much bonds you have. That's what actually is the key component of helping to control risk and impacting that return. So investing in the several different asset classes at the same time does help to kind of smooth out the path for what you can experience when the market is kind of all very volatile and all over the place. And then you are kind of dividing everything in that percentage amount. So this is often informed too by what really those goals are. That's how, and we're going to get into that in just a moment. So for an example, I added another slide here. You've probably heard of a 60-40 portfolio or something close to that. That's usually kind of the most common one we hear about is 60% stocks to 40% bonds. Whatever the first number is, that's usually the stock percentage. So it can be 65% stocks, in this case, 25% bonds, 10% cash. On the right-hand side, this is as of June 2022, this is an actual moderate investment objective 60-40 portfolio. This is an actual average based on data for how people have been investing up through June of this year. And again, this is not something we recommend you should go do this, but just so you can see, it's not just solely US only. US stock markets have been the highest drivers of return this last number of years for the most part on average. However, they are not always going to be the top performer. So that's why we want to spread out a little bit of where we're investing our money. So typically, we've seen in data shown around 46% US equity. Non-US equity would be more international, could be emerging market, developed market, basically things not in the US, a combination of those. 25% bonds, another 4.5% bonds, like international bonds. You can buy bonds that are based in other countries. We're seeing a larger cash percentage. More people have been kind of using cash as a safe haven, given how much the markets have been moving. And then a combination of others. This could be alternative investments, other types of assets people are investing in. So we talk about putting that asset allocation to work. We're really looking to the goal, our time frame, what are we comfortable with, and also our risk tolerance. For younger investors, and this is not always the case, but typically if I'm planning for retirement or someone is planning for retirement 20, 30 plus years out, you can generally take on more risk because you don't need that money right away. So in that case, I could take on more stocks. I could put more of my money into stocks than bonds because I don't need it right away and I want it to grow as much as possible. And in general, historically, stocks do grow faster than bonds, but they do have more risk. That's why we talk about that risk tolerance component. And oftentimes we see older investors or people who are retired on a fixed income now, they do more heavily invest in bonds because in general, historically, they've been a little bit less volatile. They don't move quite as much when the stock market's all over the place. They usually don't move quite as much. And they generate a little bit of income yield to help support your lifestyle in retirement. And then you still want to have a component of stocks commonly, just to have a little bit of an opportunity to increase the value of those accounts if possible. But again, there are always exceptions to the rule. Some of those would be how you're invested, again, it's keeping you up at night, something we want to look through if that's appropriate, if you're in the right investments for you. And same thing too, if you're in predominantly just cash or in your savings account and you're not really invested in the markets, really want to think about putting some of that money to work for you for your future. All right, so this is my slide on staying disciplined. And this is through 2021. It's basically a 19-year snippet or snapshot of the average returns for the various different types of asset classes in the markets. You'll notice the S&P, and we're not going to get into all of these, but there are a number of different types of asset classes. They're not all exactly the same. They have similar or different risk and return components. So that's kind of why they can get categorized together, but that's also why we split them out, because they do often behave differently depending on where we are in the market cycles and a lot of other dynamics. S&P during this time frame from 2002 through 2021, which is including the great financial crisis that we all experienced, average annualized return, so average annual return for that was 9.5% in the S&P. We have things that are high flyers, but they can also go down a lot. Bonds are more, on average, 4.3% return. We look at here at real estate for homes, 4.2%. And then if we do look at that 60-40, meaning that 60% bonds, 40% stocks, that's more like 7.4% over that time frame. That was the return experienced. And if 40-60 would be 40% stocks, 60% bonds, was a 6.4% return. But the area I want to point out, inflation was at 2.2% over this time period. That's why we had that historically low inflation. We've had historically low mortgage rates this whole time. Cash wasn't yielding too much, but the average investor in orange here, based on data in the last 19, 20 years, the average investor actually received a 3.6% annualized return over this time period. S&P was 9.5. These other asset classes higher too. Bonds are even higher than the average investor, and certainly that 60-40 portfolio that has a little bit less risk, certainly higher. So why is that? Oftentimes, we don't stay disciplined. We have our investment plan, but then we see some of those headlines, or we're trying to move things because we read about a certain company or a certain stock, certain meme stock, like all the ones we're hearing about, GameStop and the rest in the last 2 years, and we move our money. And we oftentimes end up shooting ourselves in the foot with a lot of these decisions. And this plays out over pretty much any time frame. For investors, we are our own kind of worst enemy when it comes to our actual market performance. So that's why it's important to have a plan, know what you would like to be invested in, but also just stay disciplined. So that's why you check periodically, not every day, and structure your investments so you know I'm comfortable. If the market's going to be down 20-something% this year, I'm going to be okay. My main expenses are covered, so I don't need to play around too much with my investment account. We want to leave it for the long run. When we leave it for the long run, that's when we see these higher returns in the long run than an average investor who's kind of often playing around with the money a little bit more. So that also leads into talking about diversification a little bit. We've certainly brought that up a couple of times here. So that's really taking your money and kind of dropping it into buckets, into some of those various asset classes, because again, they do have different return characteristics. So sometimes we do a combination of long-term bonds and short-term bonds, large companies, like an Apple or a Facebook, and a combination of small companies that you might not have heard of. And then some international, as well as some of those emerging markets, because not everything is in the US, and sometimes those areas do outperform compared to the US. So you want to consider also that combination of individual securities, meaning if I were to buy Apple directly, that's an individual security, versus mutual funds and those exchange trade funds, or ETFs, you've probably heard about. So mutual funds are a combination of a number of different companies, a stock of a number of different companies, kind of packaged together to make it easier for investors to know what they're getting into without having to do all the research that comes with staying invested in an individual company. It's similarly with exchange traded funds. They're just a little bit more, they're built differently, a little bit more tax efficient. So again, weigh each new investment for the diversification it adds. It sounds great in theory. It's how do I actually go about doing that? But if you're to look at your investment account, or what you have, if you have a personal account that you're using, are you predominantly invested in those big name, large companies, the Apples, the Teslas, the Facebooks, the Netflix, the things we hear a lot about on the news? Those are all be considered large, and they usually can have higher returns, but they can also can be a lot more volatile. They have more risk involved with them too. So you want to take a look because you do want to have a spread. It does help provide you a little bit of a buoy when the markets are all over the place. So case in point to show that, it's hard to see this chart. Don't worry so much about the various buckets and what each one of them means. But this is looking at those individual kind of pieces, those asset classes, those little snippets of the US economy or international stocks or bonds, whatever. It's looking at those little breakdowns on an annual basis. So the biggest thing to note is the fact that the colors are all over the place means that just because something was a top performer last year or 2 years ago or so on, does not mean it's going to be the top performer this year or going forward. That's why it's really important to use that, whether it's a combination of that 60-40, if it's a 70-30, or whatever is appropriate for you. That's why it's important to have that, because not any one single thing is ever going to be the winner across the board. So while we see some of these in blue here, these are REITs, real estate investment trusts. So sometimes they're the highest, but sometimes they are very, very much the lowest or some of the bottom performing asset classes. So you just don't know. That's why it's really hard to to always pick a winner. That's why we see in white here. This is the combination, that asset allocation, the mix, the blend of the stocks and this. You have a little bit of a smoother ride. And a lot of what my job is as a financial planner and investing on behalf of clients, as well as our whole industry, a lot of what we're doing is looking to understand those goals so that we can select the most appropriate asset allocation, so you don't experience those 40, up 45 years and then down 37 years in one given year, and all of that movement. Those huge swings are often what makes investors want to pull their money out of the markets. So we want to limit that and have a bit of a smoother ride, which is why that diversification does matter in the long run. So when choosing your investments, we want to identify which ones have the potential to deliver, that return that you're looking for. So how do you go about doing that? There are a lot of tools. If you were to research in Google, there are a lot of free tools online even to check at some of the specifics, the characteristics, return characteristics of every individual company and kind of mutual fund as well. So really encourage everybody, do your research. If you feel inclined to work with a financial professional, do so, but make sure you're really thinking through what those investments, like what those return and risk characteristics are for when you're investing your hard-earned money. And then, of course, choose the suitable investments that are really fit into your goals, as well as that diversification and that asset allocation, so that you're not 100% in tech stocks and you're not 100% in just in savings at your bank account. You want to spread it out a little bit more. So a couple key things to point out. Some of these are certainly going to be obvious, but don't put all of your eggs in one basket. Really try to not only have one or two investments. So I've heard about this company and I like this company, that's it. We want to see a minimum at least 10 to 12 different ones, a minimum to be invested in, and ideally a combination of those mutual funds and exchange traded funds, and not just individual company holdings. Don't put money into those investments if you don't understand the investment. Make sure you do a little bit of your research or reach out to a professional to get a bit more knowledge about that. And then again, don't overload on company stocks and try not to chase the hot performance. I think that's where we can see and have a recent lesson between the meme stocks and the GameStops and all of some of the Bitcoin and digital currencies and how much they've experienced like huge rise up, but they've also had some pretty significant falls. So it's really important not to chase the ones that are just doing the best, because there's no guarantee that the future performance is going to be what was experienced in the past. So what does work? What approaches do work? Starting early. And I wish we had more time to go through the importance of starting to invest early. It doesn't matter if it's $20, $100, $1,000. The earlier you start, the better off you'll be, because you get to take advantage of that, those longer term looks. We talked about one account went from 100,000 to that 539,000 over the course of that 20 years. Of course, that was just in this US stock market, the larger companies. But that's why you want to start early. You're giving your account more time to compound. you really don't start to see the really big impacts of how long the money's been invested until you start getting into that 15, 20, 30-year time frame. That's when you really start to see the huge gains and the huge increases in your account value. Invest regularly and automatically. If you can, if let's say you look at your cash flow each month, you have an extra $50 after your emergency fund, covering all your expenses, covering all those debts that you're required to cover. Maybe it's more than that, maybe it's less. Set up an automatic transfer, whether it's into your investment account, into that IRA, if you set up an IRA, or just a one you want to kind of play around with on the side. Invest regularly and set it up to go automatically so that it kind of does the work for you. Dollar cost averaging. What this really means is rather than putting all of your money in all at once, we're always like, oh, I don't know what's going to happen with the market right now. I don't know if I should I put my money in? Should I not? And we all kind of hold off and get kind of stuck in some of those places. Think about taking the same amount of money each time and investing it and just dropping that in over time. That's kind of more your dollar cost average, you're averaging into the position. So you're not beholden to one particular time period. Direct deposit from your paychecks, having those, again, same things that go directly into some of these other areas from your paycheck, whether it's into your savings or your 401k contributions, taking advantage of technology so that it's out of sight, out of mind. Because if the money's in our account, oftentimes we end up spending it, right? And then the most important one approach that's going to help you be successful is actually staying in the market, staying invested. Even in a brutal year like this, it is important to know this too shall pass. It's not going to stay this way forever. It is important to stay invested. We are our own worst enemies, like I mentioned before, when it comes to investing. If you're confident in the investment you chose, this is why we choose and we make our investment plan in calmer times when the markets are not all over the place. We want to stick to our strategy. So when the market is having a difficult year or a difficult time period, we know we have conviction in what we invested in, and we're going to stay the course, and we know it's going to get better. So another example of that, compounding that time value of money. If I were to invest $10,000 one time, and the average annual return was 7%, in 7 years, that $10,000 turns into $19,000 and change. In 20 years, we're looking at $38,000. In 30, we're actually looking at over $100,000 from a one-time investment of $10,000. Again, assuming that 7% return. This is why that power of compounding, that the time you have to invest, the more time you have, the earlier you can start, even if it's starting small, it makes a huge difference in the long run. And this is the case in point to show that. Related to your investments, it is important to keep an eye on the expenses. If you're not directly buying a stock of Apple or a specific stock, if you're buying a mutual fund or an exchange traded fund, there's often a fee. It's called an expense ratio related to it. It is important to really understand what that expense is. There are oftentimes a lot that are very, very inexpensive now, but there's some out there that have some gotchas. So pay attention to that because it will eat away at your returns. Be mindful of taxes, but again, you should not completely structure your investment strategy around taxes. If you have significant gains in your personal investment account and you sell those positions, that actually is a taxable event, and you will need to claim that on your taxes the next year. That's a good thing, though. We want to be in a place where we have to pay taxes because our investments increase in value. Again, monitor your investment strategies to stay on target, and then rebalance or check in every once in a while. Make sure that your portfolio, if you decided I wanted to have a 60-40, 60% stock, 40% bonds, you don't want it to shift too much because certain things have grown more than others or certain areas have done more poorly. And very quickly, that can become a 70-30 or a 75-25 because the value of the underlying investments have increased and it's completely changed the risk dynamics of what you're invested in. And your plan is going to evolve. It's not something we stick to. We make it once and it stays put. Your goals are going to change. Your financial situation could change. Your time horizon could change. Maybe you're more comfortable or less comfortable with risk. And then also what's going on in the economy. And as you become more familiar, or if you are already an experienced investor, that oftentimes you reevaluate what you're invested in because you might have just be more comfortable So you want to address that on a regular basis. If it's needed, just do a check-in. We like to do that at least annually. How have things shifted for me? What's different? Have I had any big life events? Do I feel differently about risk? Am I comfortable with how I'm invested? Just have those kind of infrequent check-ins, but make sure you do them. And then looking forward, again, it is, like I said here, a voyage of discovery. Investing is a voyage of discovery. We learn from it. We learn from our mistakes. But an individual mistake, like it said here, it's not fatal. Even if we put in one investment that hasn't done well, or we are, oh my gosh, the market's so down this year, I'm in a bad spot, everything's going to be okay. The key part is, what did we learn from it, and apply that to the future. So in summary, professional expertise can help you make decisions. We are not advocating for everyone to do that. If that's only fits the right situation for you, it can help you kind of coordinate those decisions. But your situation, everyone's situation is unique. There is not one set way something should be done. So you want to make sure whatever your plan is, whether it's investments or across the board, you're taking into account what matters to you, your goals, your risks, and your priorities. And then ultimately, you are responsible for your investment results. No one can do it for you. We have to take on that accountability because we are choosing to invest our money. We are signing on that we could actually lose money or gain money, hopefully gain money in the long run. A couple quick books that if you are interested or you want to learn more about investing. John Bogle, some might be familiar with him for his very large company. That he pioneered back in the day. So it's The Story of Vanguard and the Index by John Bogle. The Little Book of Common Sense Investing is a fantastic book as well for if you wanted to learn more about investing in general. Morningstar Guide to Mutual Funds. You can Google these things and there's a 5-star strategies for success, but you can even Google and take a look at any of the different individual stocks, bonds, etc. And you can find out more information. It's all available online for the most part. At least summary data is for you to review if you're interested in learning more. Search.org, that's actually offers multifaceted search options for location, how much a planner charges. If there are specialties, a planner has a specialty, whether they focus on special taxes or retirement or working with divorcees and widows and people going through a life transition. There are lots of different types of planners out there, and you can easily find these for a free consultation and then in your geographic area. But one most important thing too is also if you're considering getting professional help, make sure you're checking out their record on Broker Check by FINRA. And I believe the SEC was doing a workshop as well. It's really important to understand, do they have any disclosures? Is there are there bad reports about this person out there? That's all categorized underneath it. And it has to be available to you. So do your homework with their investment professionals as well. So thank you so much. That's the end of the presentation. We're going to open it up for questions.
Now I'm unmuted. Thank you, Jamie, for a great presentation. I learned a lot. Let's get to the questions. So we have one that came in from Dawn. Are certified financial planners also a fiduciary? And what is the typical cost to hire a CFP?
Don, that's a fantastic question. Certified financial planners are fiduciaries. Anytime we are providing any sort of financial advice, not just financial planning investments, but literally any type of financial advice, we are fiduciaries and we're held to the fiduciary standard. We have quite a bit of continuing education, examinations, annual checks, qualifications for experience, the rest that we have to abide by, and making sure we're putting the client first. I'm sorry, I missed the very end of the last question. Caroline, if you have that.
What is the typical cost for a CFP?
It really depends. There are a lot of different business models. Thank you for bringing it up. I apologize I didn't address that. It really depends. There are some planners now that will just provide, you can just do a financial plan, and that can range anywhere from $500 to 5,000 or above for a financial plan only, depending on the complexity as well as the firm itself. You can also find, that's where that plannersearch.org shows you how they are actually charging. Some people charge on a subscription-based model, and the majority of planners do charge based on assets under management or an AUM fee. So it's that small percentage. If they're investing your money, they only get paid from invested by how much they're actually investing, and they'll get a small fee from that. But there are a bunch of different service models, and it's important to understand how they're getting compensated for sure.
Okay, thank you very much. A few more questions. Is investing in bank CDs a good investment?
Another great question. And good investment is hard to say because it depends on you, depending on your situation. For a very long time, their interest rate with a yield on a CD was so low because inflation was so low and the Fed funds rate was so low that you really didn't get a lot of return on your money. We have since seen that change drastically just within the last 2-3 months. A lot of them now can yield up to 3.5%, 4% on even, it's on a short term, only a couple year. So it does depend on the one. You should look into them at your bank. They are safer, but your money is locked away. So another thing to consider, if you need to access that money, you won't be able to. You're kind of locked into that to some extent, but it can be, and they're very, very safe. But as long as those interest rates are higher, they're giving you more yield. They can be, but again, it depends on your situation. But they have been, quote unquote, a little bit safer this year for sure. More than a little bit. Yeah.
Thank you so much, Amy. I think I have time for just one or two more. I have an emergency fund and take out cash from my portfolio, savings, or retirement account. How much do you have to pay in taxes for something like that?
Okay, so you have an emergency fund and you take out cash from savings or retirement. So a couple points related to this. If you the last place you should take money from is your retirement account for a couple of reasons. If you're under 59 and a half, you have a 10% penalty from the federal government because they want you to have that money for the long run. That money oftentimes has not been taxed yet, so you also have to pay state and federal taxes on the money. That is the one we want to keep, and that's the last place. That is the last resort. I have no other options. I have to pull from the retirement account. For the emergency, and then this is if you wanted to develop an emergency account, I would take it from, or kind of earmark the savings account or open up a separate savings account that can be just your emergency money that you maybe can't access quite as easily if you find yourself transferring money in all over the place. But if you do have to take it out of your portfolio, one thing to note, you'll get a tax form from your bank custodian if you did have any gains in those positions. They have to keep track of it for you. But if you did have if it increased in value and you held it less than a year, you're going to pay how much it grew. You'll pay your full tax rate pretty much on that money. If you held it over a year, you can then enter into long-term capital gains, which we didn't talk about, but that usually has a lower tax rate for most people if you've held it over 365 days. But but in terms of savings account, there's no tax consequences there.
Okay. Thank you so much, Jamie. So I think I'm going to wrap it up because we're running out of time. So thank you again for a wonderful presentation. If anyone missed any of this presentation, it'll be on LAPL's YouTube channel shortly. The website is, youtube.com/Los Angeles Library. And please join us for a month of wonderful financial planning programs on topics like investor protection, savings, estate planning next week. And on next Saturday, October 15th, we have Financial Planning Day. And that day, you can talk to one-on-one have a telephone consultation with a certified financial planner. And you can go to our website, financial planning page website, lapl.org/financial planning. All the information is on there. And you can also register for Financial Planning Day for next week as well. And thank you again. And Jamie, you're great as always. And I hope everyone has a wonderful rest of your day. Thank you so much. Have a good one. Bye-bye.
Thank you.